Welcome to the 401k Resources channel with Matthew.Knight. This series breaks down employer-sponsored retirement plans for both employers and employees. Each episode covers everything from basics to advanced strategies with expert interviews and relatable stories. Join Matthew to learn how to take control of your retirement savings and build your future. Hi everyone, in today's new video series, I have Mark Robinson, Vice President, Retirement Plan Services with T. Rowe Price. Mark, welcome.
Hey, thanks for having me.
Yeah, you bet. Mark, if you would, tell us a little bit about your background and how you got into the business on retirement plan services with T. Rowe.
Yeah, it's hard to say now, but 17 years in retirement plan services. So started right out of college and
a veteran now.
Yeah, I guess so. Started on a desk making about 180 calls a day. Was a wholesaler shortly after that. Was managing some reps at one point, and now I've been an advisor, and now with T. Rowe Price as a retirement plan services wholesaler for 3 years now.
Awesome. So 180 calls a day. How do you keep your energy up making 180 calls a day? I know it probably doesn't take that anymore in the modern era, but tell me a little bit about that, 180.
When you're 22, 23 years old, you got the energy for it with the hopes of you'll be off the desk within a year. So that was my goal of getting out of Rochester, New York to be able to move somewhere else. And so you kind of grin and bear it, but it was great learning when it comes to this industry of not, being able to handle rejection, being able to, make those calls, pick up the phone no matter what, because that helps with a lot of success in this industry.
And you make that last call at 8:59 p.m. There's a cutoff time?
You try not to interrupt dinners too much. You don't want to be you don't want to be that telemarketer.
Dinner time is tough.
Yes.
Well, Mark, I wanted to bring you on to talk about target date funds.
Yeah.
Now, acronym TDF.
Yeah.
And I'm an acronym person. You'll hear me throw those out, but we'll always put show notes on there about what those are. So target date funds, they've been around since about 1994.
Yeah.
So, going on 31 years now, the Pension Protection Act back in 2006 named them an approved QDIA. That's Qualified Default Investment Alternative. So tell us a little bit about the target date fund, some of your industry expertise on it, and sort of what it's designed to do. We'll go over some details, but I want you to lead off with.
Yeah, I think you gave a good background there. I think in 2006, right when I was starting, you saw the race to target dates. There was only a few companies that were providing them, but when that legislation came through, we realized, before then, if you didn't make investment elections as a participant in the 401k, you didn't know where your money was going. It could have gone to cash, which might not have been good for you. It could have gone to stocks, which might not have been good. So, the PPA, when that came out, we saw a lot of investment managers race to get target dates available. A few were already out there, as you mentioned. So what I like about the target dates, and I think for participants, is you are now in a allocation that's accurate based on your age. So not many people look at the markets as you would, or other financial advisors, or I would. Some don't even know what a difference is on a stock or a bond. But being able to go ahead and be in a target date allocation based on your age, rule of thumb, younger folks can be more aggressive than older folks. And that's what those target dates do. And every time I do an education meeting, I tell people, we've all heard, don't put all your eggs in one basket.
Sure.
Compared to pre-PPA in 2006, I think everyone knew of the Enrons of the world and, getting burnt by being too aggressive or in one single stock.
Definitely.
Those target dates really helped in diversifying people and putting them into something age appropriate with a glide path that'll help them hopefully achieve retirement.
Yeah. So you mentioned glide path, and I think that's a good segue into the next topic. Let's say I'm a participant and I've been transferred into a new 401k, or my employer has started one up, and suddenly I find myself into target date year 2030.
Yeah.
My buddy next to me has got one that's target date 2055.
Yeah.
And you talk about glide path.
Yeah.
Can you explain a little bit for those watching what that's really going to mean when you see that year tagged on to the end of the fund?
Sure. So the year of the fund is when you're approximately going to turn 65 years old.
Okay.
So if I get enrolled into a plan and I never make an investment selection and I am in that 2055 fund, that's approximately when I'll be 65 years old. So what's that, 30 years from now? So I'm 35 years old. The nice part about it is both funds are accurate based on your age. So somebody that maybe is 50 can't handle the volatility that a 30-year-old can have,
Of course.
because they have so much time to get to retirement. Whereas in 10 years, you might need that money a little sooner, and you don't want to see the ups and downs in the markets. So if I'm a 25-year-old and I'm auto enrolled and put into a target date, I'm probably in a majority of stocks and funds that are going to be more volatile than if I'm a 60-year-old, where I'm more in bonds and cash.
Right.
And the beauty of it is, if I never log into my retirement account, I never look at it again, that glide path will automatically reallocate you so that less stocks happen and more bonds, so that you're a little more conservative coming closer to retirement age.
Yeah, good. So Mark, it would be like this. I'm younger. I'm heavily allocated to stocks. Glide path means I'm gliding towards a more conservative allocation as I near my target age,
Yes.
which is 65.
Yeah.
So in the beginning of this era of target dates, to go back to the early or the mid 90s here, they might have gotten a bad rap when they came out. And a target date fund is sort of a fund of funds. It's a fund wrapper with a series of other funds tucked inside. Would you say that's a pretty accurate description of how it's built?
Yeah, I would say, again, it goes back to that diversification,
Yeah,
right?
yeah.
It's not just one company you're buying. You're not just buying one stock. It's a group of mutual funds that all invest in different things. So that goes back to that don't put your eggs in one basket kind of idea.
And since it's a good qualified default for a plan sponsor, very compliant there if the employer doesn't make an election, but can definitely come back and make an election later if they want, not stuck in it. What are some cons? I mean, we've kind of gone over advantages of it, sort of self-implied, but would there be any downside to being in a target date? One thing that I think of, so it comes to mind, I hit my target year. Does the fund become totally conservative? It may not be enough, because I look at risk as two sides of one coin. You could take too much risk. You could take not enough.
Yeah.
What's your thoughts on this?
It's a great point. So I think we're all, as an industry, trying to solve that problem of how do we make sure there's income in retirement. This is an 70, 80 plus year solution we have to create, right?
Sure.
You're probably working for 30 to 40 years and hopefully living to 30 or 40 years through retirement. So you have the beginning of the glide path that you need to possibly make up for lack of savings. So maybe it's more heavily allocated to those stocks to get you more growth. But on the vice versa of that is, if 2008 happens and you're still in those stocks and that money, you're 60, 65 years old, that hurts.
You're walking out the door with a
50% loss, possibly.
Down significant
and
loss,
that hurts if that's
good.
Income you need. So
totally.
What's really come around lately is a lot of thoughts around adding income options, guarantees, even annuities within the target dates, so that if we can get you to retirement, how can we make that almost like a pension feel, to where you as a participant are getting some sort of monthly income and feel comfortable that you're not going to outlive your savings.
Okay.
So it's a like I said, that 80 plus year solution, get enough money there that you have the pot to play with. And then how do we make it so it's systematic and easy for that participant in retirement to have that pension type payout? I'd say the only other bad rap I know of for target dates is we don't know the whole picture sometimes.
Yeah.
If you're 50 years old and maybe you have a pension, maybe you have other outside assets, without knowing that, if you get defaulted into a fund, you may have too much risk tolerance or not enough. So the glide path can sometimes be not the correct one. I've seen a lot of 40, 50-year-olds say, hey, I'm more aggressive than what most people my age are. I don't want to be in the 2040 fund. I want to be in the 2055. And you have that flexibility.
Sure. Okay, good. Now, one thing I feel like folks may trip up on, target date fund versus asset allocation fund.
Yeah.
I could see this show up and I could say, okay, well, what's really the difference here? I could just pick this and it's really the same as that. Is target date the same as allocation? This is a fine line, I feel like.
Yeah, I would say, again, neither is a bad solution, and a lot of plans have both.
Yes.
I think of asset allocation as a stagnant portfolio, where if I go and be aggressive at age 25 and I never look at it again, I'm still aggressive when I turn 65. So the beauty is they will rebalance, but it'll keep you in that aggressive portfolio or moderate or conservative. Whereas the target dates have that built-in glide path to where as you age, you stay in that fund's going to reshift and reallocate stocks versus bonds versus cash.
Yeah. I think one note to say about that, with the technology that's available on platforms now, coupled with advisors on plans that are there to make sure participants stay on the right track, I feel like it's an easy problem to sort out. It may seem daunting to someone who's looking at it for the first time, thinking, oh my gosh, what is all this stuff?
Sure.
What are some tools out there that you think are good that participants need to know about if they don't know?
Yeah, I tell every participant in an education meeting that we run is it's very hard to out-invest your way out of not saving enough money. Okay, so there's no guarantees out there, and so the tools that we really go around in the industry are normally helping you understand maximizing employer match, right? If there's free money on the table, make sure you're using it. Yep. Roth versus pre-tax, what's going to help you best with your tax situation?
And there's calculators for that.
There's calculators that shows, absolutely. I think a lot of these tools that are, you could Google them and just find out, what's best for you, but getting a good savings rate going and putting it into an allocation that is going to have that glide path or at least some diversification to it. We can see a lot of folks becoming millionaires just because they said it and they didn't look at it again, and they're putting away 10% or 15% between their portion and the employer match.
Mark, I appreciate these valuable insights. Thanks for coming into the show today.
My pleasure.
Thank you, Mark.